Okay, folks, welcome to part two of the Inner Circle Traders Market Maker Collection. This is volume two in a series of 12. This particular module, we're going to be dealing with integrating commitment of traders data and institutional order flow. Now, if you haven't already seen my older teaching as it relates to commitment of traders, I did two topics specifically dealing with commitment of traders. One was way back in 2010. Um, I dealt with just simple core concepts to kind of like more or less warm up the audience that had recently at that time subscribed to my materials and resources that were making available on the internet and YouTube. And then I had a later, much more comprehensive teaching as it relates to the Commitment of Traders report. And I believe the title is How to Trade Forex Like the Professionals. And it was dealing specifically with the Commitment of Traders, CFTC data, and looking at the net positions and um, whether they're net long or net short basis, the Commitment of Traders graph that usually is accompanying many of the weekly charts that provide futures price data. But I'm confident that there are certain things that were left out that will be beneficial to you as we discuss it here as it relates to institutional order flow. And when is a net long or net short collectively in the commercials valuable to you as a trader? What prognostication does it give us as a trader? Because there's many times that the commercials can be net long or net short and really just be hedging in the marketplace and not necessarily mean that it's uh, a definitive good buy or good sell at any given time. So let's take a look at the beginning slide here in this presentation. And again, we're going to be talking about the net traders position chart. And on the left hand side of here, we have the weekly Australian dollar. And I used the futures data. This is the cash price, okay? But I'm showing you how you would use the futures price with the currency pairs in the spot market. For instance, the Aussie versus the USD, using the futures commitment traders report and graph at the bottom on the left hand side, you can arrive at a discernment whether or not fundamentally commercials are bullish or bearish on that particular market. And on the right hand side here we have a daily Australian cash price with the COT plotted as well. And we would use the same analysis concepts with the Aussie USD with the understanding that we're sharing here. Now in pairs that are showing the Australian dollar or whatever particular pair that we would be studying in the futures market as the secondary in the pair, for instance, like we're discussing here, Aussie USD, if instead of the USD, say it's the Australian dollars being plotted against another pair as the base, that would obviously be a mirror image of whatever you would see in the futures market, because the futures price data, while they are closely similar in terms of the spot market related to the dollar, um, it's important you understand what the relationship is. It may be a mirror image based on what we're describing here, um, if it's not the base currency in the pair. Okay, so in other words, um, if it's the Aussie on this side here and not here, obviously it would be a mirror image of everything we're expecting in the charts as we're discussing it. But moving ahead, let's look at a little bit closer view of that Aussie. This is a cash price again. And I want you to take a look at under the chart here, we have this graph. Now, if this is the first time you've ever seen a net trader's position chart, it can be a little bewildering because you probably don't understand what it is it's measuring and what it's plotting and what's the cumulative basis of this information. Without going through a whole treatise on the concepts of commitment traders and CFTC position reporting that takes place on a weekly basis, I'll just say this. Um, the CFTC, which is the Commodity Futures Trading Commission, mandates that uh, positions in the commercials which are the large dominant producers or consumers of a commodity. Um, Large institutions, banks, okay, they would be a commercial. Okay, and then you have the large speculators, which would be hedge funds, large private traders, and then smaller mid-sized companies, if you will. And then small specs would be someone like you and I, where we just don't have the accredited staff working with us or a real fundamental need to be in a particular market. We're just in there speculating. Okay, and that would be deemed as a small speculator. Now, historically, if you look at the red line here, okay, the red line that's being plotted is the commercials. Okay, and as you can see here in the legend, the red is commercial speculators. This is the small specs. We really have no interest in following them. I wish there was a way to toggle that particular group of trader off of the CFTC's data, because it's really not useful at all, I've found. And then you can see here the large specs, which is the green line that's being plotted here. Now, if you look over here, there's a zero level here. Okay, and I want you to follow that line across the NetTrader's chart, because as price, as it does here on the red line, crosses over top of that red line, this is the beginning of what is referred to as a net long position in the commercials. Now, they are both speculative and they are hedgers. Okay, and what do I mean by that? Well, because there are vast, huge, deep pockets in these commercial traders, okay, and I'm just going to refer to them as a bank. Okay, it makes it easier for our discussion as it relates to currencies. The banks are the red line here. Okay, if they are above the zero line, as we just indicated, they are net long, or they have collectively over their entire speculative interest in the Australian dollar, they are more net long or bullish than they are net short or bearish. Okay, so in other words, if there is a make it easy, they have essentially about 100,000 contracts long here on the Australian dollar. In other words, they may have 300 thousand contracts at interest in terms of the Australian dollar. Okay, but net long basis, they have more. They have 100,000 more longs than they do of another side. I guess that really wasn't a good that wasn't a good indication of or example. It's not 300,000 interest they would have. It would be something like say they had 150,000 contracts, okay, of open interest in that particular currency. 100,000 of the position size collectively is more of longs than they are of selling or hedging into the Australian dollar. So I think it's a better illustration of what I'm saying. Now, the the fact that they swing from net short to net long here, okay, doesn't really suggest that there's going to be a bottom in the market yet. What we want to do is you want to see a diametrically opposed position between the green line, which is the large hedge funds, if you will. They are by definition the trend followers. Okay, now during the meat of the moves, they are generally right, but they are always wrong at the end of the moves. In other words, at the tops and the bottoms or major turning points in the marketplace, that's when they're going to be at their most heaviest net long when it's topping out, and when it's net short, okay, they'll be uh, the heaviest net short during the lows in the marketplace. Okay, and you can clearly see that here during this time here at this high, they were heavily net long, or they expected higher prices. At the same time, the banks are saying, no, it's time to turn this bad boy around, and the selling pressure began. As the two crossed here, okay, you can see that they're always diametrically opposed, okay? The banks are offering the liquidity and the means to do the trading that the green funds, okay, or green line rather, are able to um, be able to take the other side of the marketplace. So, in other words, as a hedging aspect or a hedging perspective as it relates to commercials, okay, those parties that are providing liquidity or offering the risk of owning Australian dollars, okay, they are the sellers, if you will, of Aussie dollars. Now, that that group of traders, okay, that are trend following in nature, they would be interested in being in long-term trends. And because fund managers of large funds and hedge funds, okay, are trend following in nature, okay, because they have such a large pool of equity to work with, they're not inside an intraday chart speculating, 10, 15 pips here and there. That's not the basis for their business model. They want to be in large long-term moves. There's going to be a lot less action on their part in terms of managing, but they're hopefully going to be right for the long haul and get big pockets of moves between important highs and lows in the marketplace. And funds are always beginning their data study on the monthly and weekly charts, okay, and then primarily keying off of daily charts. Now, the reason why I'm taking you to the COT is because while I am not quote unquote a fundamental trader, I do believe there are fundamental reasons for markets to move long term, not short term, long term. On the short term, we're going to learn that there's absolutely a very clear indication that markets are manipulated. Okay, and one could argue and say that's not right, but there's a way of capitalizing once you understand the business model they use for that manipulation, and that's going to be discussed in the third volume of the 12 that's in this series. But for now, as it relates to this topic, what I want you to look at is take a look at this chart here, okay? And I want you to see that it's not just essentially the net long or net short position being held by the commercials, it's the action of the commercials in relationship to the green line, which is the large funds, and looking at the overall market structure in the Australian weekly chart. You can see here, back here, all through this time frame, okay, the Aussie had commercial net sellers. In other words, they were net short for a multiple, of at least in this chart showing an indication of at least about 2 years they were net short. Okay, they had never been net long during this entire period of time. Well, if you are just understanding net long and net short, okay, this is going to be confusing to you, because if you look at that same time frame between 2010, around the beginning of the spring, end of spring, early summer, you can see that the Australian dollar did in fact move from around that 81 or 80.50 level or thereabouts. I'm just eyeballing it. Okay, rallied all the way up into around the latter part of summer in 2011, where it traded to around 110, big figure, and then it made its high and then subsequently moved lower for a multiple of 2.5 years or so. So now looking at the relationship of how the commercials relate to long-term trends. There are times when the sellers will just keep the net position below the zero line. In other words, they're net short, okay? But the market will be in a raging bull market, okay? Price will move well beyond the expectations of just simply looking at if the net trader position on the commercials, again, that being the red line down here, if that's going to show a selling scenario, we have to understand that how does that relate to price? Because if we aren't paying attention to price, it's going to be absolutely useless to us as it relates to prognostication and determining whether or not we should be buying or selling a particular currency pair. I want you to take a look at right in here, the move that began right here. We had a rapid reduction of net short positions by the commercials. You see that? While we are not, okay, we are not net long, we do see a big drop off in the longs held by the hedges or hedge funds. So we have the commercials widening the interest in the long side and lessening their interest in the short side, and that is going to be indicated by a reduction, a rapid reduction, which is key, of their net short position. Because of their net short position being rapidly reduced there, okay, there are reasons to believe, if in fact, that price was at a level of important support, a institutional order block that would be bullish, okay, or if they have moved back to an area where we will talk later on about mitigation in terms of where the beginning points of market structure shifts takes place, okay, and how to identify and quantify whether those things are true in price action. If we see those things line up with a rapid reduction of net shorts by the commercials, and it's qualified with a rapid reduction of net longs by the large traders or large specs, that is the same thing by definition in ICT camp of a net long position, okay, because they're wildly uh, bullish compared to the heavy net short position they were holding down here, okay. Fundamentally, they know something's going on here that makes them lessen their short position, because they were heavily short here. If you go straight up, that was here, okay. Price comes down and they really rapidly covered their shorts there. Why would they do that? Because they fundamentally believe, okay, and they have more trained accredited staff that are closely attuned to quote unquote supply and demand factors that govern price action. They believe that prices are going to be undervalued here. If that's the only indication that that would cause that. Otherwise, they would maintain a net short position or increase the net long short positions and just therefore, heavily sell into it. But you can see, while we did have a rapid reduction there, price acted the same thing you would expect as if we were in a long net long position here, as we have commercials were above the net zero line here, and we have a very nice tradable rally here. Now, you can see again all through here we have that same understanding of what we would anticipate, okay, the commercials to be doing if they are trading at a level of key support and resistance. Now, key support and resistance comes in the way of horizontal support and resistance. We do not look at diagonal trend line support and resistance. It doesn't mean anything to us because price does not respect diagonal lines. Price respects clear turning points based on specific price levels that are easily discerned based on horizontal lines. Okay, if you look at just the many times that using the grid that's accompanying this chart, if you follow that across the chart to specific handles here, like the 96 big figure, okay, that particular level was very sensitive. You can see a couple periods where price did in fact find support and resistance around those around that level. The 94 big figure in this chart as well had very clear support and resistance evidence there. And again, we understand that would only happen if there was a real fundamental, quote unquote, okay, basis for those turning points. Now, there's so many ways to ascertain, fundamental data. I'm not going to go into that and try to even make a point that I know how to use it, because I've openly discussed how I do not sift through fundamental reports. I do not follow all of the resources that are made available for fundamentals, because I don't believe you can adequately keep up with all of it. But there are certain means of keying off of specific reports, because the central banks do get sensitive to one or two at most, but mostly one market driver, okay, for a period of time, and when that goes out of favor. For instance, it could be well, they're always interested in employment numbers, okay, but it might be the CPI, it might be something one of many of the core market drivers and reports and data that release on a monthly basis. Whatever one's in flavor right now, okay, that's the one everyone's going to be hawking and making sure you know um, their data is in line with expectation. But even then, just because it may be a good number, fundamentally the price action may be doing something completely and utterly opposite. Okay, so I don't look at market data releases and market drivers like that as a means of knowing what direction it's going to do. Um, I look at those report time releases as just injections of volatility when to anticipate number one, manipulation, okay, and then two, opportunity. So let's pull back to what we're talking about here and keep everything germane with COT. If we understand that if there is a rapid reduction in net shorts or if there's a large net long position, in other words, above the zero line, okay, by the red line, they fundamentally believe that there is an underlying bullishness to that particular market. Now, this doesn't just work in currencies. It works on agricultural markets like corn and soybeans and all that. If you're a futures trader, it works in meats like trading cattle and hogs. It works in gold and silver, palladium and platinum, copper. It works in the oil market, obviously. It works in the treasury market and debt instruments as well. It's not limited to just this, and it also works in index futures as well. Now, if we understand that the sheer uh, evidence of rapid reduction or increase, okay, of a position by the commercials, and it's also seen with the contrary side of the market being the green line. In other words, whatever the red line's doing on a weekly basis, we take a look at it. Okay, and if you're only watching one pair, okay, it's very easy to keep up with this. But if you're watching a dozen pairs, so you can still do it because you're looking at a rather large macro perspective. And generally, the macro perspective will have a similarity amongst all of the closely related pairs. For instance, currencies. Generally, they should all be moving against the dollar, mirror image. But sometimes there are pairs or currencies that buck the trend, okay? And there may be a really stellar underlying strength in a particular country, and it may not drop when all the others are trading lower against the dollar. Okay, it's those instances create all different types of scenarios that are outside the scope of this discussion here. But when we do have a clear indication of net long, net short between the two camps, that's what classically has been defined as a buy or sell scenario. And the first person to bring that to light was in the trading universe, where as it relates to retail trading, was back in the 70s with Larry Williams, where that's who I learned it from. He was the one that made COT data widely popular through the 70s and 80s and 90s, and still to this day. Um, the the notion of, again, just simply looking at the net long and net short position is not enough. Okay, when we look at the commitment of traders report graph at the bottom of the weekly chart, okay, it's important you understand that if we take that into account with, okay, with order blocks, okay, that we learned in the ICT Scout Sniper training series, and the further amplification of that with the higher time frame order blocks seen in my Precision Trading Concepts series. Um, if we blend the concepts of like the order block here, okay, and we have a price decline prior to the move here. So we know that if we get back down to this particular level here around 190, oh, I always add in one, I don't know why I do that, but the 92 handle, okay, when we get into this region here, we would anticipate something quote unquote fundamentally bullish about it. Well, wouldn't you know it, the commercials are net long. This is the heaviest net long position they had for multiple years here, okay, much more than we were here. Okay, same thing here. We were net long. By itself, it means absolutely nothing. But with a net short position on the funds, okay, we have a diametrically opposed tug of war between the two. Okay, the red line, think of the banks. They are going to put a stop to this market going lower. In fact, it's more true when you see the bullish order block that we have here, the down candle prior to this rapid, rally higher. When we trade right down into this area here, boom, there you go. There's your long position, begging you to get in there and start looking for longs between the 96 to 98 big figure. Between that little area. Now, obviously, you can take these down in smaller time frames and refine that, and which we'll do. Okay, we'll do that. But for now, I want you to look at just understanding what we look at price in terms of support and resistance, um, the notion of order blocks and market structure as a whole. We have a price decline here. Okay, rather sharp price decline. The bullish candle prior to this move lower, we understand that the smart money sells into bullish moves higher, and they buy into driving pricing lower. Okay, in other words, when price is dropping, that's when they're doing their buying, because their volume, their sheer volume, requires them to accumulate long positions as the market's going the opposite direction. If you you can't imagine how hard it is, okay, without having done it with a large account. Everyone thinks, well, you're just going to make multiples of the same type of thing on a smaller scale. That not always the case. I mean, you're going to have to be a little bit more nimble with your pricing and getting in and get out. And if you're trading large size, you're going to absolutely need price moving the opposite direction. So in this case here, as price moves higher here and blowing out this high here, okay, price drops down. We know that in here, we know that the smart money was selling. Why? Because look how fast it moved away from it. No one in the retail world is going to cause the futures market to drop like this or the spot market to drop like this. Okay, only the large deep pockets of traders that have a lot more money than you and I collectively occurring are going to cause this price action. Okay, the bottom of that candle, the low on that bullish candle prior, draw that out in time. This is where we return back to that bullish order block. So the orders that took the market up here, that we were selling into, we had revisit of that same price point, and that would be sensitive as well. And would you know it, the commercials are net short. Look how net short they are. Okay, and you can actually see the ebb and flow between the commercial relationship and price action in this example. Now I'm using the Australian dollar simply because everyone knows that my pet pairs are fiber and cable, which is the Euro USD and British Pound USD pairs in the foreign exchange market. But I do occasionally trade other pairs, and I really want to not just sell you the idea that it works in my two favorite pairs, but it works in all the currencies. Okay, we have a small trading range in here, okay, of about 400 pips or so. Even in here, as price moves back and forth to these highs and lows, okay, if we break that down into a daily chart, we can see where all of these rapid reductions, okay, of net shorts and then further increasing of selling going into the 2003, we can see that the fundamental picture was that they were selling into that consolidation. They were building large positions every single time price rallied closer to that 106 to 105 and a half handle on the Australian. That means that we would anticipate a breakout. Okay, now not we're trading breakouts, but we would anticipate a move out of that range to the downside, not to the upside. Okay, and we had price slip through an old low here. Okay, so now we have on a weekly basis another price point that shows market structure bearish. It broke through here, comes down, trades lower, right back into what we were talking about earlier, this bullish order block here, and rallies up. Where does it rally back up to? This low. Well, the longs that took price up here, if they were holding through this period of time, and yes, there are funds that do that, they would have to unwind their long positions as we traded back here as a trader's remorse scenario. In other words, they're remorseful for the longs that they've had to sit through all this pain. Now when it comes back up to that price point, okay, they had to mitigate those losses. And we're going to teach more about that in another video in this series. But for now, we can see clearly that there is an opportunity for weakness to come underway. Okay, and look what happens. A rapid reduction of net longs by the commercials. While they are net long still, look at the drastic drop in that red line as we rallied up. They undone a lot of the long positions they held here, right here. They unwound them, okay? And you can see clearly that that was the indication in this chart as well. Now, again, it's important that you understand the trend of what the commercials are doing, okay? Not just simply the net long or net short position held by them. Okay, and again, just as well as we saw the reduction in the net long position by the commercials, we saw the rapid reduction in net shorts held by the large funds, because there's going to be someone taking the other side of the trade, and only the funds can absorb the liquidity that's offered by the commercial traders because they're so big and they have such a large pocketbook, if you will. Their orders are vast, they're huge, and it's going to require large funds flows to come into the marketplace to absorb all that. Again, we have another bullish order block here, the red candle here, prior to this rally up in price. And you see that happens to be right there. Price comes down and retrades into this bullish order block right there. And wouldn't you know it, a rapid increase as we did this. Okay, net long positions by the commercials, nailing the low down, and then boom, rallies up. Now, where does it rally up to? Look what it rallies up to. The old bearish order block, the bullish candle here, the bottom of that candle, trade that out in time, bang, right there. Okay, it trades up and fills this range. Okay, this is how we trade inside the range. If you went short in here, covered here, and then traded in here to the long side, just in these two turning points here, that's several hundred pips. Okay, easily 1,000 to 1,200 pips that could have been easily harvest out of those two cycles in the marketplace. Now, as price trades up into this area, okay, we're also trading at an old low here. Okay, we're trading an old high here. Okay, so we understand that this is a level that's going to have a lot of impact on the higher time frame. In this whole area right in here, okay, there has been an increase of selling, 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 selling. In other words, the commercials were selling net short. They were heavily net short or bearish here. Okay, well, why wouldn't they be? Because you have a bearish order block here, and price worked that level for a long time. When it does that, okay, when it does that, you're going to see a really huge, big move. Okay, and you can see that is the case here with this bullish order block here, the green candle. Okay, the bullish candle prior to the move lower. Okay, follow that low across here. You can see, look how many times they worked in that range. Okay, boom, they sold into it here, they sold into it here, they sold all to here, here, and one more time they built enough of their orders in the position to hold on to that. And then finally, look at the breakout that took place going lower from around 106 all the way down to 88. Now, I don't know about you, but that would be a nice ride to be in. If just holding a standard lot, that's a good chunk of money for someone in the retail world. But in here, let's go back to the previous chart where I was indicating the COT data over top of the daily chart. And you can clearly see that there was, again, several optimal trade entries in here if you're familiar with that. Just small little retracements back into uh, bullish candles. Okay, and again here, another retracement here. Okay, and then finally the breakdown and continuously move lower. The low here that we're trading at in this example can be also closely tied to where we traded in the 2010 time frame on the Australian dollar. Right in here, we would anticipate no bullish indication at all in these wicks. The wicks don't mean anything to us. Okay, so we'd have to go back out to a higher time frame and look at a range that's beyond the scope of the low that's formed here. But even though we do have a wildly bullish net long position on the commercials, it just may be them hedging much in the same vein that we saw it here. Okay, they had a net long position. It was just a hedge, buying, causing another opportunity for the price to rally up. We would sell heavier into it. Okay, see how we had selling pressure here with just a lessening of the net long positions? But then look at the heavy net short position here, because we are now in sync with the overall trend, okay, where the position had been established here based on the premise of this high being the higher long-term high in the marketplace. This was the large position that began this long-term macro trend lower, and just keying off of price points as we just discussed with these lows here and the order blocks over here. Okay, inside of this level of trading range action with the accompaniment of the net short positions by the commercials, what this tells us is that we would be more inclined to be looking at selling rallies. In other words, selling into bullish order blocks. Every time price would rally up into a previous order block, whether it be a daily, 4-hour, or 1 hour, okay, those should be with the coupling of time and time of day and time, day of week. If we understand that, we could have really good chance to see profitable trades to the downside, and focusing only specifically on selling this market only when this context is visible in the marketplace. Now, looking at the British pound, this is a weekly chart of the British pound cash price. Okay, the same thing happens here, guys. There's nothing different. Okay, it's not just form fitting simply because the Australian dollar just simply had good examples of it. The same things appearing as well. We have price action, clearly showing highs in here. Okay, Price comes down, makes a low, and then rallies back up. Where does it rally up to? Inside of this bullish green candle, which is the bearish order block that moved price lower. Okay, we revisited it here. At the same time, it's very barely visible in here, but trust me, if you go to your own COT data, you'll see that we were net short in the commercials held in the British pound. In here, we have price finding some support at an old fractal low. We have an old low here. Go straight through here. You can see that 148, that 148.50, 149, big figure in here. It would be one would expect bullishness, and then you can see clearly the net positions on the commercials were heavily net long, much more long than they had been in previous years. Okay, we would expect bullishness. Now, if any of you were following me during the 2013, 2012 time frames, we were calling these lows in market reviews before the fact. We were talking about these particular levels on a smaller, detailed, you know, explanation as price traded down into it, and then when we were anticipating higher prices as a result. We also see this relationship between the commercials and the order blocks here. We have a bullish order block here, which is the green candle prior to the move lower. See how fast price was moving away from that? That's how we know that inside that green line, the smart money had sold right in here. So if we come back to that level, which we do here, okay, look what was going on in the commercials. Rapid reduction of net longs. They're only going to do that, okay? If they thought that it was going to keep going higher, they would have never loosened up their longs. They did. Look how fast they unwound them. And then what did price do? Come all the way down and blew out stops on a higher time frame basis. It blew out stops on a higher time frame basis, and then boom, rallied. Okay, and then they started selling into this rally, hedging all of this because they accumulated such a large order base of longs in here. Okay, that's all this was here. From this point here all the way through here, this was all building of long-term longs. Okay, this is a big buy program for them. So what's a buy program? Buy program is when they're heavily net long and they'll sell as price rallies. Okay, what they're going to do is they're going to hedge, okay, their positions, and they'll sell out at logical areas when to anticipate price being profitable for them. And you can match up all that as you can see here. It's not very hard to tell. As price rallied up into this level here, previous order block, okay, that 162 level, right in here, and you can see what they did. Okay, they were selling. Okay, they sold heavily into this area here. They sold heavily into this area right here as price was making higher highs. They sold into this decline here in their position. They're selling heavier net short as price was making higher highs and higher highs and higher highs. And look at the high in price. It's right at the time when they were the most heaviest net short position being held by the commercials, and that's what the price was done. It topped it out, and once they do that, then you can see the return of price moving lower. Now, if the weekly chart is not as clear to you as I'm making it seem, the monthly chart plotted with the COT, in which we have here is the euro. Again, this is the daily, I'm sorry, the monthly on a cash chart. If you look at where the COT charts indicate, okay, you can clearly see when there's a 12-month extreme. Okay, each vertical line here represents the beginning and end of a new year. When you see that and you see a new, fresh, higher high or lower low in the commitment of traders, that's usually an indication the market's going to make a key turning point. And you can see that in 2010, where the commercials are heavily net long, right in here, and that makes the bottom in the market, but not by itself. It goes back into a previous order block that's bullish prior to this big move here, and you see that rally here. The market returns back to a bullish order block here, right there. At the same time, we have a 12-month low, new 12-month low with the net short positions by the commercials. That's going to be a major important selling indication coming into the euro. And the same thing goes throughout this chart. You can see it multiple times. It gives you an indication that we come back down into this previous order block here prior to the move higher. Trades right into it, you know it, boom, heavily net long position. Heavily net long position. We'd anticipate a long-term buy program to come underway. Price comes back up to what? A previous order block that's bullish candle, which is a bearish order block, right when the commercials are net sellers. Okay, and I'll leave the overall study of each individual pair to you using this concept, but it gives you a really wonderful way of blending the two of order blocks and institutional order flow and support and resistance with commercials.